The Crypto Markets Update is presented by Grayscale, the world's largest digital currency asset manager.
All right, checking in on Bitcoin. The CoinDesk Bitcoin price XBX index currently trading at $48,840. Bitcoin is sliding about 2.5% over the past 24 hours. The CoinDesk Ether price ETX index trading at $4,266. ETH is also retreating about 0.6%. And the new DFX CoinDesk's DeFi index is at 435 points. DeFi in retreat about 1.2%. Joining us now to discuss the crypto markets is John Wu, president of Ava Labs, creator of DeFi protocol Avalanche. Hello there, John. So when we took a look at this crypto markets retreat, what is behind this, and how do you see this persisting?
I think it's been in retreat roughly about a month or so already. And if you look at the asset class, it kind of is following the high growth stocks in the US equity market. So it's actually a reflection of risk appetite. But underneath the hood, there's a lot of dispersion. And that dispersion is frankly tied to where the markets are seeing real utility in DeFi, utility in enterprise adoption, utility in NFTs, and utility in gaming. So the ones that are outperforming are now showing more utility, and there's high correlation there.
Yeah, John, I want to ask you about the layer one tokens, for instance. Where do you see things headed in the next few weeks and months? Do you think that they'll outperform Ether itself? And if so, how will that happen and why?
Well, Ethereum is outperforming Bitcoin, even though Bitcoin's up 70% this year and the S&P is only up about 22%. And a lot of the alternatives like Avalanche and the other ones you mentioned earlier are outperforming Ethereum. And again, that is a reflection of the growth and the growth in terms of the operating metrics related to the utility. I think going forward in 2022, that trend of correlation between an outperformance of price or market cap with utility and the growth of adoption of certain chains is going to continue. Now, if the whole market goes down for tapering reasons or for whatever, you're going to see outperformance from the layer ones, because the layer ones are basically the best way to play the overall utility in the space.
Have we separated the layer ones and Ethereums from Bitcoin itself in the sense that they will be completely different narratives, or do you think that they will continue to have still this high correlation? I mean, even though we look at it differently and we see some difference in pricing, nonetheless, overall, when based on US dollars, they seem to always go together. I mean, the correlation coefficients are still very high. Do you think that's going to break in 2022?
Well, you're correct. There is.
Yeah.
Right. The correlation is still high between the two, but it is not as high as it used to be. If you just grab a chart that shows Ethereum versus Bitcoin, you can see the outperformance, and relative to itself, it's breaking out in terms of you graph that chart. So I think the market now is treating this whole asset class of 2.5, 2.7, depending on, what day, because of the volatility, trillion asset class. Underneath, it's different for every single token. It's no longer, the smart money, if you will, is really looking at differences as opposed to just buying the whole asset class. To the point that there is still high correlation, frankly, it's because where liquidity is. When new institutional investors want to get into the space, some of the smaller tokens that maybe have great, utility and growth in the early days just don't provide the liquidity that's necessary for them to get part of this asset class. And if I want part of this asset class, having 70% return on Bitcoin this year is still better than 22% in the S&P.
Did you happen to watch the congressional hearings yesterday, John? And I wonder what were your takeaways on it with respect to how decentralized finance might be regulated?
I was pleasantly surprised by the overall testimony, almost all 5 hours of it. I think as an operator, what I saw was healthy dialogue between regulators and Congress with the practitioners. And I think the practitioners can learn some from the regulators and Congress and vice versa. So there's a good, healthy dialogue. The operative word is dialogue. I did not expect a dialogue. I think even Sam said there was no grandstanding, and that was, very encouraging. I hope that continues. There's going to be more meetings in December. And frankly, if that can continue, we're off to a good start. There was some good dialogue there in the sense that you heard things that really resonate to people who are in the space and operating. The concept of the younger generation really being familiar with tokenization and actually preferring that as a method to create value in terms of assets. That digitization is something that's just natural with the younger generation. And maybe the rules that have been around for literally 90 years. I mean, it was the Securities Acts of 1933 and 34. Those were set and probably very good in a world where there was analog and lots of intermediaries. In this close to a century of time, there's been so many regulatory adjustments to tweak because there was so many technological innovation. But now we're at the point where crypto completely changes the way things can work. It's a paradigm shift in innovation. So maybe the 90-year-old rules need to be tweaked or completely changed. So having a dialogue and an educational exploratory forum like that and healthy conversation was actually very encouraging.